Should retirees consider life insurance in Canada? Let's find out today. Retirement should be a time to relax and finally get a chance to enjoy life after decades of hard work. However, even during this period of your life, financial considerations are still important, and one financial instrument often overlooked by retirees is life insurance. It's commonly assumed that life insurance is not necessary for retirees or that it's too late to get life insurance because most retirees are at their 60s. But the reasons to maintain or even purchase a new policy are compelling. But before we get into that, let's first take a look at what kind of financial problems retirees will face first in Canada. The first problem that retirees in Canada are facing is ongoing debt. According to Statistics Canada, a significant number of Canadians still carry a mortgage or other substantial debts into retirement. The average debt for a 60-year-old is still around $436,000, which consists of mortgage, credit card, line of credit, and car loan. And that's not all. Roughly 1 in 5 Canadians over the age of 70 still have an outstanding mortgage or other debt with an average balance of $125,000. And given today's economy, this number will increase. And don't forget, as we live longer, we need money for medical care as well. And that could easily deplete our retirement saving and put us further into debt. Just like assets, most of the debt will carry forward to the next of kin, meaning if your kids don't have the money to pay off the mortgage, the bank will take the house away. The second one is tax implications. In Canada, many sources of income you rely upon in retirement are taxable. This includes personal savings such as the registered retirement savings plans, the pension plans from your work, government benefits such as the OAS Security, Canada Pension Plan, and not to mention if you have other passive income such as the rental income or dividends income from stock investment. So during retirement, if your income is more than $80,000 a year, and you'll be paying 22 to 25 tax bracket depending which province you're in, meaning 1/4 of the income is gone to the CRA. Also in Canada, the death of an individual triggers a deemed disposition of all the assets. In other words, the government considered the recently deceased person to have sold all the properties and other assets at the market value just before their death. This could result in significant capital gain taxes on their investments. For example, if you still have $500,000 left in your RRSP by the time that you pass away, the whole $500,000 will be considered your last year income, and that will push you to the highest tax bracket, and easily 50%, which is $250,000, is given to the CRA. And if you have multiple investment properties at the time of deaths, then they will assume you also sold all of them at the same year, and the profits could be talking about millions of dollars. Again, under the capital gain tax, half of the profits will be considered as income, and therefore 25% of the millions portfolio will be given to the CRA. And if you don't have the money to pay the tax, the government can force sell your property, take the shares, and give you the remaining money. Therefore, it's important to know how the tax problem you could be facing and able to leverage different kind of tax advantage tool. In Canada, there are only 3 truly tax-free tools. 1. The TFSA, the tax-free savings account. 2. Your principal residence. And number 3. The life insurance, which we are going to talk about that later. Alright, problem number 3 is the estate aspect. Let's say if you have no debt problem nor don't mind paying taxes to the government, how would you like to distribute your assets to the next generation? For example, Peter and Jane were retired already. They have 2 kids, and the only main assets is the principal house, which worth roughly $5 million. Peter and Jane already have a will that said once they pass away, the kids will be the owner of the house. Long story short, both Peter and Jane passed away, and here's the big problem. John, the son, neither wants to sell the place or rent it out so everyone gets the money. But Mary, the younger daughter, wants to live in there as she was recently divorced, and she does not want to sell the place nor rent out the basement as she wants privacy. So at the end, they have to take it to the court. Lots of time and money were spent, but yet there's no results. No one is winning in this battle except the lawyers. And is this really what Peter and Jane, the parents, want to see? So what can life insurance do in this case? First off, life insurance proceeds are not considered taxable income, meaning your beneficiaries can receive the entire lump sum tax-free upon your death. And life insurance policy are private contracts that do not go through the probate, meaning you can shield it from the prying eyes. That means the beneficiary can use the money to pay off the debt, the final expenses, and the final tax bills. And compared to those bills, the cost of insurance is literally pennies to dollars, enabling you to pass on your legacy without financial burden. In addition, depending on the types of insurance you are using, you can move assets from the non-register, which is taxable, to the insurance, which is now tax shelter. For example, I have clients who own 5 to 7 properties in Canada. They sold 3 to 4 properties in their retirement as they don't like to manage tenant turnover, interest rate hikes, and the capital gain tax. Instead, they park their money into the life insurance. Sure, the rate of return may be lower, but it's growing consistently, tax shelter, much less management. The insurance can also give my clients a consistent retirement income during lifetime, and it's going to be tax-free cash given to the next generation, which provides a lot of flexibility. Which relates back to the Peter and Jane problem. They could buy a permanent life insurance of $5 million and the proceeds would be split equally to the kids. If Mary, the daughter, wants the entire house and John just wanted money, Mary can use her $2.5 million proceed and buy out John's share, or she can create an annuity with the life insurance payout, which can create a passive income for John. Meanwhile, Mary can have the 100% of the ownership now and everyone is happy. For retirees in particular, choosing the right type of life insurance is important decisions influenced by a range of factors such as health, age, financial status, and what you hope to accomplish with the policy. The first type of insurance you can get is called the term life insurance. Term life insurance is a type of policy that offers coverage for a fixed period, usually between 10 to 30 years. Once the term is up, policyholders have options to renew, although usually at a much higher premium. The primary advantage of term insurance is its affordability, which is especially attractive for retirees on a fixed income. It's also relatively straightforward to understand. If the policy passes away during the term, the death benefit is paid out tax-free. As simple as that. However, there are drawbacks. The first is a limited time frame. If you outlive the term, which is usually at the max age of 85, then you don't get any payouts. Second, term life insurance does not accumulate any cash value, which means you cannot deposit or withdraw the money in the life insurance for tax advantage purpose. The other type of life insurance is the permanent life insurance side. On some occasions, retirees with existing term insurance coverage often have the options to convert it into a permanent policy without having to go through the underwriting process again. There are generally 2 types of permanent life insurance, the whole life insurance and the universal life insurance. I have a playlist of videos that talks about them, so I'm not going to go through them in the details in here. In short, the benefits of permanent life insurance is obviously its permanency and the added feature of the cash value accumulation, which can be withdrawn, invested, or borrowed against. During retirement, policyholders can tap into the cash value for supplemental income. They can do this either by withdrawing directly from it or by borrowing against from it. It's a resource you can use to help manage retirement expenses or even fund unexpected costs. Policyholders can adjust their timing and amount of their premiums and have the liberty to make investment choices for the policy's cash value. But please, before you decide to get one, make sure to talk to your financial planner to go through the numbers. So after all of that, should you consider life insurance during your retirement? Absolutely. It should be a big part of your retirement planning. No matter when, you're always facing debt problem, tax problem, and potential estate problems. While you might think that leaving your 30-year-old condo to your kids is doing them a favor, the reality is most of the heirs would prefer cash, which offers flexibility and immediate value. Keep in mind life changes even for retirees, so it's wise to revisit your policy every few years or significant life events like the death of a spouse to ensure it still meets your needs and budget. And again, talk to a financial advisor first, especially if you want all the perks that I just mentioned. And I hope you enjoyed today's video. This is Thomas, thanks so much for watching, and I'll see you in the next video.